Good morning and happy new year. This is David Troutman with Treece Financial Group with our first Treece Talk of 2026. We had one in December, the last of 2025. New year, new talk. I'm letting people into the webinar now, so we're going to get started. We've been quite busy over the holiday break. I'm sure David will touch a little bit on that, but within our office, we have a lot of initiatives going and some new things to share to really help with your financial planning, all kinds of aspects of it, but also aging. And, we have support for solo wagers and also for the LGBTQ community. So let's take a look at some of the new things we have going on. Last year in April, David published a book, Take Pride in Your Money, LGBTQ Financial Empowerment, and that has been available. It's a part of a series called Fast Financial 101, and that is now live on our website, treecefi.com. There's a series of books. We've just published a new ebook, Your Wealth, Your Way, 14 ways that a financial planner can help you with your financial confidence. It's really taking how David works with clients every day and the philosophy of what TreeceFi has, and sharing with you how 14 ways is broken down into how we were with you through your whole financial planning journey. So if you're a client, hey, take a look at it, download it. There may be aspects we're not helping you with that you'll discover, say, hey, David's not helping me with this. I should talk to him about that. If you're not a client, this is a very good reason to read it. It's why you should be a client. So it's free, complimentary. You can download it on our website. Just go there. And I did mention Take Pride in Your Money. Take Pride in Your Money is also on treecefi.com as a Fast Financial, and you can take a look at the book and purchase it. There's also a video series of it, and we could get a consult with David through it. So take a look at that. We're publishing like crazy here, right, David?
We
Right.
are.
Yeah. So take a look at, and speaking of books, our Solo Wager, online community for support last year had a bi-monthly book club called Aging in Pages. We are doing another one this year, and it's going to be much more open to clients and prospects, and you'll be able to hear more about it. I'll be facilitating those. There are books to help, think about aging and different aspects of growing older, and also empowering ourselves. So the first session will be in February, and emails and details about that will be coming from us over the next week or so. So take a look at that when it comes out and we get an email. The first book we're going to be doing is Together, The Healing Power of Human Connection in a Sometimes Lonely World by former Surgeon General Vivek Murthy. Isolation, loneliness, the world's a little crazy right now. We need each other. Let's focus on that. And that's what we'll be talking about in that book session. Commercials. I told you we were doing a lot. So the last thing is, yes, the last thing is in our Blvd Pride LGBTQ support community, we've partnered with Stonewall Village, New York City, which is similar support and with in New York City and New York State for aging LGBTQ folks. And we have a 6-month series of called Less Fear, More Fierce Queer End of Life Planning. It's about, similar to our Date with Death Club that we've presented through our online communities before. This has an LGBTQ focus, although you don't need to be LGBTQ to participate in, grief and aging and estate planning and end of life planning. Is for all of us. Obviously, we're all going to deal with it. And we had our first session last week, and it was quite intriguing and interesting, and people got a lot out of it. We're working with a hospice chaplain, Sarah Miller, who's going to be this coming month talking about spirituality toward the end of life, and how does the LGBTQ experience get into that. So I think I'm done on my commercials. So David, I am going to say good morning to you. Happy New Year.
Happy New Year. It's great to be here. It's amazing all of the things that we do and the resources there, and then the people like Sarah Miller. She's awesome. I always enjoy talking to her. So yeah, thanks for putting all of that together. And so Happy New Year, everyone. I say, well, we have an adventurous New Year. It's like it comes with the territory these days. Today is the 1 year anniversary of Trump's inauguration, exactly today from his second term. So we're making Greenland great again, so to speak. I have a big mouth, a lot of opinions. Compliance loves me. All this has to be approved to post later. But what we're going to talk about today is what is on everybody's mind, I think, and that is the political turmoil, Greenland, tariffs, and market projections. So I have a lot of insight on this, and it still always comes back individually to your timeframes, your risk tolerance, and we have strategies that we are very proud of, where we will have money that is either safe, it's in something that's fixed, guaranteed, or it may be with a money manager who gets out of the market or reduces risk based on circumstances. One of our leading money managers has already done that as of last Monday. And it's like somehow they thought some turmoil was coming. Now, other people, this is, they would just want to be aggressive and grow, grow, grow. So they're not concerned about that. So, and again, we also have other strategies to invest with some risk control. But I'm going to talk about that. And of course, if you have questions or comments, feel free to post them in the chat here. So, why hasn't political turmoil derailed the stock market? So we had a lot of turmoil last year, and it's absolutely true that we had in April a big downturn. It did derail the stock market temporarily. That's typically what happens with a lot of political issues. Brexit was another classic example where we did not think that the people of Great Britain would vote to leave Europe, and they did, and the market tanked, but it was like 3 days. So we see this where, and here's some answers to this, why isn't the market reacting more severely? Of course, today is the first day that the markets are open in the United States since all of the threats against Europe with more tariffs over Greenland. Yesterday, of course, the markets were open in Europe and the markets were down, similar to what they are in the US right now as I am recording this, but it is not outside of normal market variations on negative news. So again, we're kind of in the same response. But this is from Opening Bell Daily, Phil Rose, and why political turmoil hasn't derailed the stock market. And I'm going to give several points of view here. There's a simple reason stocks keep rising despite the storm of political uncertainty. Even with regime change in Venezuela, drama with the Federal Reserve, chaos in Iran, asset prices have stayed remarkably composed. The S&P 500 is positive to start the year, and volatility, as tracked by the VIX, the VIX index, remains below its long-run average. The tariff shock last April helped remind investors how quickly markets can rebound from political noise. Well, there's a lot of politics here too, because it was when the market goes down too much, which is what happened last April with Liberation Day. And indeed, that's what happened. And I think that that's still on the table, even more so this year, possibly. And that's because of the November elections. So if the markets should start to show signs of, too much turmoil, particularly the bond market, then we may see some of this kick down the road like we did before or rescinded. He continues, equity investors care a lot about future earnings and a bit about interest rates, but that's the entire list of what drives stock prices, said Data Trek Research co-founders Nicholas and Jessica Rabe. In effect, politics rarely register as a catalyst one way or another, particularly when the fundamentals underpinning the market haven't changed. So that's, one thing. And also they point out the White House is going to do whatever they can to keep the economy going and the stock market strong. So this is an answer as to what we're seeing. Now, I would say, of course, and everyone else is saying there is still risk. That doesn't mean that things won't go sideways or down. So this is from CNBC, Chloe Taylor. Key points. 2026 has seen the Trump administration overthrow Venezuela's Maduro regime, threaten force against Iran, and talk up annexing Greenland potentially by force. Equity markets have been stable. Now that the markets have been slightly up in January, all three major indexes, 1.5% to 2%, that range. So as of, depending on what happens today, the markets may be flat or slightly down for January. Investors spoke to CNBC about why markets are shrugging off the headlines and what it might take to make them react. And again, it's a very similar that yes, one of the markets that really seems to have changed and gone up are precious metals, gold and silver as safe havens. But equity markets are shrugging off the news. And we've had some losing session, but overall, this is Eric Friedman, Chief Investment Officer for Northern Trust Wealth Management, which is huge. Said markets hadn't been moved by Trump's actions and rhetoric on Iran, Venezuela, and Greenland, partly because no other large economic or military powers have responded. There's a lot to unpack in that comment because if you're waiting for a response, I think sooner or later you're going to get one. This is my philosophy. This is not necessarily economics. It's like, bullies bully because they can. There's a power relationship there, which I think still exists. But when the bully gets beaten up, that's when things change. And so he says markets are looking at these events in isolation, and it would likely take a unique response to each flare up to drive more market reaction. Also, one key thing to point out, a Supreme Court decision on the legality of Trump's tariffs, so unilateral, may come out as soon as today. And we thought it might come out last week. That decision has likely already been made. And it is probably quite complicated in terms of whatever they rule. There will probably be a lot of clarifications as to how they interpret the law regarding, for example, if they strike down tariffs, will that be a forward going, backward looking? Will it involve refunds? There's all sorts of things that may be coming out of this decision, and it might be complex. So that's another interesting thing. So, and I think that is probably taken into account in some of the political calculations in threatening tariffs, where if the tariffs are struck down and you don't have a legal right, do you still try to force it through Congress, still try to do it somehow? We see what I consider absolute disorder and lawlessness, where a lot of court decisions are just being ignored. For example, Jeffrey Epstein, it's been a month. It's like, what's going on here? Again, these things don't affect the economy or the stock market exactly. So here's another take, and this is from Market Watch. The economy is shockingly strong by one measure. This year could be even better. New tax breaks, AI spending could boost GDP. So here again, stubborn inflation, high tariffs, and plunging job creation didn't do much to slow the economy in 2025. Now the stage is set for even stronger growth. How come? The economy is likely to get a boost this year from a flurry of new tailwinds, chief among them lower taxes, less regulation, higher government spending. All this is true. More investment in artificial intelligence. And here, the timing is off on this, the fading effects of tariffs. The big picture suggests that the economy continues to hum along, said economist Ali Jaffrey of CIBC Economics. Then it goes tariff post-mortem. It wasn't all that long ago that the outlook for the economy was more grim after a surprise decline in GDP in the first quarter of 2025 because of Liberation Day, a global trade war. Critics predicted inflation would surge, consumers and businesses would get slammed, and the economy would suffer a big slowdown, and it never happened. Well, of course, now tariffs are back on the table here, at least until the Supreme Court rules otherwise, or we'll find out what the reaction is. One of the interesting things I would point out is the more you get away with, the more some people try to get away with until you hit point. And I think the people in Europe and around the world have to be saying, well, appease, negotiate, deal. And it's just going to be one thing after another, in my opinion. President Trump retweeted, didn't post it originally, a map of Greenland covered with the stars and stripes, the American flag, including Canada covered with the American flag. It's like, okay, you see a trend here, and it's like, and it's only been 1 year. We have 3 years to go. and we'll see what happens. So I think there's an enormous amount of risk out there that is unnecessary. It's sad. It's policy driven. But I'm going to share another point of view in a moment where I always you don't want to live in a bubble. You want to get alternative points of view. I'm going to share right now Cetera Investments point of view. This is from Cetera's 2026 annual outlook. Economic resilience meets elevated expectations. And again, it's moderately positive. Most all of the stock market projections I did in the last Treece Talk for 2026 were positive. The stock markets, the S&P 500 will finish up by the end of 2026. Of course, nobody knows, but almost nobody is really negative. So here, from Cetera, on the fiscal side, retroactive tax cuts. That's the one big beautiful bill, and evolving trade dynamics. I always find some of the terminology used to be interesting, like trade dynamics are altering the landscape. There's a lot of smoothing over, I think, of the seriousness or the tension to try to maybe not sound so extreme, but I think what's happening is extreme. While tax cuts and trade adjustments, there we go again, may dominate headlines, it's the quieter, persistent forces like automation and AI that are steadily redefining economic terrain, much like a river carving a gorge over time. These trends may not show up in quarterly data, but their long-term impact is profound, influencing labor dynamics, supply chains, competitive positioning, and at any rate, overall, we look at these underlying things as being increasing productivity and good for growth. So the forecasts are still positive, but again, we acknowledge that there's a lot of risk here. Now, to give an alternative point of view, and this is kind of entertaining for me. So again, I have a big mouth. There's somebody I follow who is the chief economist of First Trust Portfolio, Brian Westbury, and his team. And I give him credit for always at least putting his neck out there and making market forecasts and predictions. And entertainingly, he is typically, not always, way, way, way off by the end of the year. And when I say way off, I'm talking 25% off. It's like it's hard to be that wrong. If you just go towards the middle, most of the forecasts for the S&P 500 on average are like, okay, we're going to be up 9%, which to me is so bland. It says nothing. Market averages are like that, although the market year by year usually does not end with an average. It can be up quite a bit. It can be down quite a bit. His forecast for various reasons, which I'm going to review, is that the S&P 500 will be at about 6,000 by the end of the year, which means from where the market is today, it'll be down about 12%. This is virtually the only negative forecast out there. And I joke, well, he's off by about 25% typically. So that means, the market, may be up 13%, or it could be down 37%. I'm almost like looking at his forecast as having a negative correlation to what will happen. He's so far off, but I want to read some of the sentiment here. Last year, we thought economic growth would slow. And this GDP data says we were wrong. Employment data says we were right, trying to look for a little, positivity in their really, really wrong forecast. Last year, we thought the stock market would decline. Well, it did in March and April, sharply. But overall, it finished with an impressive 16.4% gain. They also predicted that the market would be down quite a bit last year. They were way off. And so they're doing the same forecast this year. Okay. So, we're not pessimists, it says. Our pessimism was not driven by policies or the actual events of 2025. We did not worry about tariffs causing inflation or a collapse in global trade. They follow more of an Austrian school of economics, which has to do with the money supply and the growth of the money supply. Here are some other predictions that the Federal Reserve will likely cut interest rates. Our base case is 2 or 3 more 25 basis point cuts in 2026. But with a new Fed leader coming in, it could be more than that. I'm going to get back to this in a second, but The next Fed announcement for interest rate cuts would be January 28th, about a week from now. There's no meeting in February, so if rates are not cut, and they're not expected to be cut necessarily, it seems like the data are not leading the Fed to do rate cuts. Then the next one would be in March, March 18th. So we'll see what happens. Of course, there is a lot of politics involved in Trump trying to pressure the Fed to lower interest rates and to take away the independence of the Fed. There does not seem to be any credible opinion that the lawsuit, the attack on the Fed right now over the admittedly way over budget building renovations is politically motivated. That's very clear. There's just no substance to this otherwise. So the issue seems to be weaponizing government to try to get what you want. And of course, there's a long track record of doing this against individuals, institutions, law firms, universities, countries. So that's what's happening here. And that actually has caused quite a bit of negative reaction in the business community. And there is a Supreme Court hearing today on Trump's attempt to remove one of the Fed governors. And Jay Powell, the chair of the Fed, is actually going to be physically present there at the Supreme Court. And that raises some eyebrows. It's like to send a message that he is so determined to protect the Fed's independence. And there's also speculation that even though his term will end as chair of the Fed, and normally you would expect he might retire, he does not have to leave the Fed. He just would not be the chair. He could still be a member of the board. So I think this is like giving him an incentive to stick around even longer. And when you're trying to protect institutions you love, it makes sense. So here to continue on with First Trust Portfolios, Brian Westbury, their negative stock market forecast for 2026. Here they're saying positive things that the One Big Beautiful Bill restored 100% expensing for more business investment. And although the law didn't cut marginal income tax rates, it did prevent them from rising, which I think is true because they had been cut and they made these cuts continued. But again, a lot of these things are still very short term for 2028. Here's some political commentary in it's called an economic research report, Monday Morning Outlook. We fully understand the arguments many are making about the constitutionality of Trump's arrest of Maduro. We won't debate them other than to say Congress dithers while China, Russia, and Maduro thumbed their noses at the U.S. China and Russia actually liked that Maduro was a criminal and a dictator. They were supporting him. And they were doing it in our hemisphere with little pushback until now. It's great to get these points of view. It's like an excuse for law breaking, or if Congress isn't going to do anything, let the president do it. You hear this where it's like, well, I just want to get it done, however it has to be done, without respect to institutions or the law. But the very next paragraph, just to share this, a global elite who stand for open borders and, quote, reimagining, unquote, the economy and support things like the, quote, Great Reset, unquote, are now on notice. Undermining freedom one institution at a time with seemingly free reign is over, at least for now. We see this as a good thing. Why? Because any reasonable person looking at the history of our world realizes that the founding of the U.S. was one of the greatest things to ever happen. Freedom reduces the power of authoritarians, and dictators don't like this. This is referring to Maduro. But freedom is the greatest generator of wealth. It seems we are getting more of it, which is appropriate in our country's 250th year. So rather than looking at Trump as wanting to be a dictator, an authoritarian, there are views that he is attacking dictators and authoritarians, and that's a good thing. So it's always good to get another point of view. Now they continue. This is where we get into some of the risk. At the same time, the U.S. has an extremely bifurcated economy, with high-income households benefiting from rising asset values and the wealth effect while lower income households have been hammered by inflation. I agree with this. This is statistically true. More purchases, even for meals out, are being paid for with buy now, pay later. Car lenders are stretching out payment time periods. Delinquencies for most loan types have been rising. And this month, student loan collection processes will start up again. And some of the severe garnishing of wages has just been postponed again. But it's affecting credit reports. And that brings us to the stock market. Yes, we have been bearish on the market because our models, as well as every other model we know of, say the market is overvalued. And so that's where they have their formulas. So they have a capitalized profit model that discounts earnings with a 10-year treasury yield to calculate fair value. So that's where they come up with their forecast. It doesn't have to do with things like tariffs, but underlying structure within the markets, the economy, particularly with regard to monetary policy. So at any rate, the interesting point of view there. So I think it's going to be a wild year, particularly between now and November for these elections. And assuming they happen or that they are recognized, that the results are recognized, that's a referral to January 6th. So it's not anything extreme to say. Who knows what could happen? And just a couple other things that people have been asking about. One is today was also the deadline for the banks to drop interest rates to 10% max on credit cards. And it's like, okay, where's this going? President Donald Trump, a week ago, this was dated January 17th, told the credit card industry it had until today, January 20th, to comply with his demand for a 10% cap on interest rates. With just days to go, now 0 days to go, consumer groups, politicians, and bankers alike remain unclear on what the White House has planned and whether Trump even remains serious about the idea. Somebody referred to this as a proposal. There is no proposal. This was a post, like a tweet. And there's nothing by Congress that's going anywhere. And so far, the White House has not provided any detail about what will happen to credit card companies that don't lower card rates. White House Press Secretary Caroline Leavitt said the president has an expectation that credit card companies will accede to his demand that they cap interest rates on credit cards at 10%, that they're just going to do this. Okay. And if they don't, maybe they'll get investigated or sued or otherwise attacked. But that's what authoritarians do, not here. At any rate, I had one other topic. I'll just do this really quick just to get this off my chest. I am outraged at all of the pardons of financial criminals. And it's like we have to go through so many compliance hoops with everything we do. And it gets to be unbelievable. And in the book that is available now for download about all the things financial advisors can do, I had originally written this as basically how to choose a financial advisor. And I have a big mouth and I have a lot of like how the industry works, how we're regulated. And a lot of it is shocking, I think, about what goes on in the industry. And now at the top, Ponzi schemers, people who were convicted under judges appointed by Trump are getting pardoned and restitution is getting forgiven. And so people who are victims who thought they might get made whole or at least get recover something are actually getting victimized again. And there doesn't seem to be a reason for it. So, of course, the excuse is, oh, this was unfair prosecution by an overzealous Biden administration. But there's a lot of funny business where a lot of these people have been lobbying, paying a ton of money, have had made campaign contributions or other contributions. So it looks like a quid pro quo. And we'll see if more light comes out to bear on that in the future. But I think that's another sorry situation. At any rate, I've gone on half an hour. And so what I want to do is turn it over to any questions or comments. And so please feel free to ask any questions. if there's anything, and then I will try to give a shorter answer, and then we'll wrap up.
Hey, David, it's David. It's the Davids. Yes, you were giving so much information. I think everybody was wrapped with listening and taking it all in. It was a lot. But that's good. But there is a question in our chat that says, in light of international efforts to reduce reliance on the U.S. dollar as the global reserve currency, what investment sectors beyond gold and silver do you view as a hedge against the trend?
This is a great question, the whole topic. There's a big message about the fact that the stock market went up and yet precious metals also went up, because normally there's somewhat of a negative correlation, that it's like people are looking for a safe haven in times of crisis, and that gold has gone up and has gone up more this year and continues to go up is a warning sign. So despite what we're talking about in the equities markets, the precious metals market is reacting as though we need safe haven. And it is not just individuals, it's governments that are stockpiling gold. So I think there's very little of an alternative other than things that are safe and fixed with some sort of reliable guarantee. I still believe in FDIC insurance, A-rated insurance companies, those insurances, principles like diversification. Another thing that people were looking at as a way to diversify against the dollar, or protection, is cryptocurrency, and that I do not support. And indeed, the markets have shown how difficult that is. People are looking for an alternative to the dollar and to de-dollarize, and I think gold is one way to do it. Now, one key thing, there have been long periods where gold has done absolutely nothing. And you're missing out on all sorts of stock market growth because, again, when the markets are good, sometimes gold is doing nothing or going down. And there are some forecasts that gold has gone up so far, so fast that, there could be somewhat of a bubble there. In my personal opinion, is that as long as there's this elevated level of risk from recklessness and policy choices and tariffs, that gold will continue to do well. Now, once things settle down, assuming they do, then you may absolutely see people get out of gold, and you'll see a correction in the gold market. So the answer is, that's cash, gold, principles of diversification, guarantees that have some backing that are worthwhile. Those are the best ways to, I think, diversify some of the risk. There's not any other like magic bullet that I can point to, but that's a lot. There's a lot of ways to manage risk. And if people want to know that, okay, for now, this money is just going to be safe and fixed and we'll get the best interest rate we can, that may be another alternative. We do work with some investments that you can, they have restrictions, like liquidity restrictions, where you can invest with a guarantee, an underlying guarantee, like from an insurance company. But again, you have to look at the overall investment to see if it fits what your timeframes, risk tolerance, liquidity needs are, especially liquidity there. So if there's a particular investment somebody wants me to look at, I'm happy to give my feedback on it.
That was a really good question and a really good topic to kind of look into. It's the only one we have. So if anybody else has anything else to say, if there's anything else you want to wrap up with or share as we close up, I'll leave you to it.
The final thing, and I will make it fast, is don't hesitate to reach out to us. We're watching the markets events very closely. It's easy to drive yourself crazy with day-to-day events, but as I started and emphasized over and over at the beginning from various sources, you do want to try to separate your politics and events from your investing to a certain extent, and not because you can miss out. But my personal opinion is that there is risk, and if you have some concerns about it, we try to plan for that risk way in advance by using some of the strategies So it's like the time to have these strategies in place is before something happens, which is what we're doing. We always comment when something extreme happens. Our phones are not ringing off the hook. People are already pretty well positioned and they understand what they have. So that's a point of pride for us. I think we do that differently than the vast majority of financial advisors. So that's don't let all of this drive you crazy. Focus on what you can control. Make sure you're properly positioned. Reach out to us for a review or for suggestions, and we'll be happy to meet with you, do a Zoom meeting or a phone call or one-on-one, and we'll take it from there. Now I'll shut up.
No, well, actually, there's a late question in the game here. In our Q&A, it says, I know 6 people that have lost jobs due to AI. Where is this going?
I think it's absolutely true that there are efficiencies that are expected from AI that this absolutely will, not necessarily overall for the job market, for the unemployment rate, but for certain industries. I think writing, translating, I don't see this as a huge negative for the economy by any means. I see it as a positive that this is absolutely something that will increase efficiency. I use this regularly, constantly, and I'm absolutely amazed at it. Sometimes you can get a faster answer to something using AI like Chat GPT, like rather than going to a company's website and trying to figure out, okay, what's your policy on this? It's like Chat GPT. When you get an answer, of course, you need to verify things or double check it or dig a little deeper, perhaps. But I think it's an amazing thing. I had health issues this past year, open heart surgery, and it's like that I'm learning so much so fast, verifying things with the doctors. The doctors say they use it. So I think that this is a tool that some people will use, and it will increase their efficiency, make them better employees. And there are other people who can easily be downsized. You look at the energy that's being used and the construction of these huge data centers. So there's job creation there, at least temporarily. So in any new technology breakthrough, you've got winners and losers. And overall, I think this is something. And also on the investments, here I am going longer than I wanted to. There's a lot of circular financing between like the AI companies and chip producers, and it's like, again, there could be winners and losers. Some companies may do very well, and some may find that all of their investments do not pay off. And so we can see that in stock prices. But I definitely see AI as being transformational. I don't minimize it at all. I think that it will, and not everybody's even using it or aware of it. It's like, I'm old enough, I'm 65, where I can remember there was no email, there was no internet, there was no Google. And I mean, it just gets more and more transformational. So, for younger people, you can't imagine how not having these things. So I think it will continue to be transformational. And then what's next after AI, even?
Well, we're definitely hitting the shift of very heavy, very large paradigm shifts in society and the way we work. I just want to clarify that we do use Chat GPT within financial work. However, it's a compliance approved product, and we use it within compliance ways of using it.
Very good.
Yeah, and making sure there's
another
no
thing
client
is
data is it's very regulated, just like everything else. So
we are super, super regulated on all of this, and we always try to do the right thing and follow the rules. But some of the amazing things is to have our meetings where we can see the work. It's like summarized, or the transcripts. There's so many things that are just amazingly efficient.
So there's a follow-up, I think, to the AI question with what happens to the what happens to the economy if there are less spenders because they do not have the money, which I think
this is one of my
lots of jobs.
Yep. This is absolutely a big concern. This is a whole nother topic. I call this the bottom of the pyramid, which means if the bottom crumbles, the top crumbles too, or gets affected. uh, even here with very what I would consider right-wing economic commentary that is very pro-Trump, very pro, and, lower government regulation, they're recognizing this. And, in the past, you might have higher taxes on the wealthy, and which we had before under Reagan. The tax rates were much higher for the wealthier. And we would have, like the estate taxes, the exemptions would be lower. So there'd be, right now, we have a big problem with Social Security and Medicare financing. In 2033, 2034, there's not full financing for either of those programs. And so theoretically, it's like 80% of the benefits on Social Security get paid out. So if you cut or raise taxes, get rid of the cap on the earnings limit on Social Security wages, then a lot more money comes in. So, but there is this huge separation, and that could be a problem where you have this third worldization. You go a country, and the United States is in terrible position here. Most other countries have much higher taxes, like in Europe, rather, developed countries. But then again, do you want that? Do you want their healthcare systems? This to me is a fair political question. What kind of country do you want to live in? The size of government, the safety nets at the bottom. These are fair political questions, but I think it can become a much larger issue for a society if you have not and there's a lot of, like, the rich are getting richer and everybody else struggles. And I see this in a lot of institutions, a lot of places, a lot of the country, cities versus the rural. I think it's destructive. And I personally would like to see policies that will avoid this, that will lift up the bottom and lift up everyone. And right now, a lot of the policies, in my view, favor the wealthy. And I think it can be very troublesome for a society. Of course, that's where then it's up to people to get involved and voters to vote and politicians to implement programs. That's where we got Social Security and Medicare to begin with, to help elderly people, poor people, and we'll see. But yeah, it's an issue. Okay, I'm going on way over. I mean, not that there's a deadline for this. I try to like do half an hour. So on that, if there's no other comments, I'm going to sign off. Thanks everyone for joining, and we'll see you on the next Treece Talk. And David Trotman's doing a phenomenal job on our website and all these other programs. So please visit treecefi.com and see all the things that are there, because there may be some things you're interested in participating in. Thanks, everyone.